Guess we can get started. Good afternoon, everyone. Thank you all for joining us here today. My name is Jerome Franks. I'm the president of CFA Society The Bahamas, and it's a pleasure to have you all here as we kick off our annual financial literacy series. This is our fourth year of hosting the series. The series originated from one of our key objectives, which is to perform outreach to the public by providing educational seminars such as today. This year, the series will consist of 4 weekly seminars where we have a speaker discussing topics that we deem to be the most impactful for the greatest amount of people, I think, within the country. Among the topics that we'll be discussing are saving and budgeting. Next week, we'll be discussing investing fundamentals, followed by home ownership and the credit bureau. I think given the recent announcement of the service lots offered by the government, I know there's been a lot of excitement, a lot of interest surrounding that. So I think this year's seminar will be very timely, definitely considering a lot of the topics that we're going to be discussing will be very beneficial for those who want home ownership, as well as for those who want to build wealth and be financially stable. So I think there's a lot to be gained here. I know definitely those who would have implemented a lot of the principles that we will be discussing are the people that will likely have the best chance to seize a lot of the opportunities that will be in the market as they arise. All right. So without further ado, I'll briefly introduce our organization and then our speaker for today. CFA Society The Bahamas is an organization of financial and investment professionals, the majority of whom hold or are pursuing the Chartered Financial Analyst or CFA Charter. Our members are among some of the top financial and investment professionals within the country. For more information on the Society and CFA designation, if you are interested in the designation or a career in investments and finance, definitely visit our website, cfasociety.org/Bahamas. If that doesn't work, just try cfasociety.org and then click on Bahamas. All right. So our speaker for today is Tiffany Smith-Cartwright. She'll be discussing the topic, saving and budgeting, financial lessons learned from the COVID-19 pandemic. Tiffany Smith-Cartwright is an investment manager at Kalina Financial Advisors Limited, or CFAL. She is responsible for the management of CFAL's discretionary and advisory accounts, including mutual funds, pension plans, companies, and individuals. Tiffany graduated from Temple University, where she obtained a BBA in finance, summa cum laude. She obtained her Chartered Financial Analyst / CFA designation in August 2015, and the certificate in investment performance measurement credential in November 2018. She's a member of CFA Society The Bahamas, and she currently serves as our secretary. Please welcome Tiffany as she leads us here today. Tiffany, over to you.
Hey, good evening, everybody. So on behalf of CFA Society The Bahamas, thank you for joining us today. Today we'll be talking about saving and budgeting, financial lessons from the COVID-19 pandemic. So like Jerome mentioned, this is the 4th year of our award-winning financial literacy series. And when it comes to financial literacy, one of the most important concepts is saving and budgeting, which is why we always start off the series with this topic. However, we've tried to switch it up a bit this year as we are in the midst of a pandemic, and the pandemic has had a major impact on a lot of people's finances. So our agenda for today, we will talk about the current economic situation, fundamentals of saving, the importance of an emergency fund, lessons learned from the COVID-19 pandemic, and then I can take any questions at the end. So I just want to talk a bit about the current economic situation. Because we're talking about lessons from the COVID-19 pandemic, I think it would be good to discuss the current economic situation because the state of the economy has had an effect on the country and individuals' finances. So we all know the COVID-19 pandemic is the biggest health crisis of our time. The virus emerged in China in late 2019, and the first case emerged in the Bahamas on March 15th, 2020. That just happens to be my birthday, so lots of luck there. The Bahamian tourism sector makes up 60% of GDP and 50% of the workforce. Tourism arrivals declined by 76.6% year over year in 2020, and cruise lines have not entered our waters since March of 2020. In 2020, the world experienced the highest levels of unemployment since the Great Depression, but as countries reopen, people have returned to work and unemployment numbers have gradually declined. The pandemic has brought tourism in our country to a standstill, so that's had a major impact on the country's finances and our unemployment numbers. Recently in the news, Royal Caribbean and Crystal Cruise Lines announced that they will use the Bahamas as a home port, which should bring some cruise activity to the country and bring tourists back to the downtown area and hopefully spur some more employment. Countries around the world are experiencing second and third waves, and some countries are experiencing a slow vaccine rollout, which threatens the global recovery. It seems that we may be having a third wave in the Bahamas with the recent uptick in cases. However, hopefully with the vaccines, we can get things under control so we don't have much more damage to our economy. The IMF projected that the Bahamas' real GDP contracted by 16.2% in 2020, and the country is not expected to return to pre-pandemic growth levels until 2024. The Bahamian economy actually never recovered from Hurricane Dorian, and then we had the pandemic which hit us in 2020. Our recovery is highly dependent on the return of tourists to the country. So like I mentioned, hopefully with vaccines, we can have a bit of a pickup in travel and more activity can come to the Bahamas. The Director of Labor, John Pinder, estimates that the Bahamian unemployment rate stands at 20 to 23%. It is estimated that the unemployment rate was as high as 40% at the height of the pandemic. Prior to the COVID-19 pandemic, 90% of bank accounts had $10,000 or less. Prior to the COVID-19 pandemic, only 30% of companies provided company-sponsored pension plans. Also, NIB only offers temporary assistance. The Unemployment Assistance Program started in March 2020 and has been extended until the end of April 2021. So those eligible for that Unemployment Assistance Program receive up to $100 per week, which obviously is not a lot of money to work with. So it's important to have an emergency fund, which I will go over in depth in this presentation. So I didn't go over all of that to bring gloom and doom, but to provide a background of where we are at and highlight the fact that the downturn in the economy has severely impacted people's finances. The current state of the economy has made people more aware of the need for savings and an emergency fund, as many have lost their jobs and had little to no savings. Prior to the pandemic, the country was in a bad state when it came to saving. Bank accounts were very low. A lot of people did not have pension plans and ended up relying on national insurance. And the pandemic has likely made this even worse. Since the pandemic, NIB has been strained due to all of the unemployment benefits. So it's best to be prudent and save, as we don't know how much will be available to us from national insurance in the future. So if you still haven't gotten your finances in order following the pandemic, today we are going to discuss the major aspects of saving and budgeting. And hopefully following this, you can make steps to improving the state of your finances. So there are several building blocks which make up the fundamentals of saving. The first and most important block is to set a budget. So ask yourself, what is your income? What are your expenses? And what adjustments can you make to save more for the future? The second fundamental block of saving is to save consistently. It is important to be disciplined with your saving by setting aside a certain amount per month, whether it's a dollar value or a percentage of your income. So ask yourself, do you have retirement savings? Do you have an emergency fund? Do you have other investments? If not, you have some work to do, but it's obviously never too late. And the final building block of saving involves minimizing your debt. So minimizing your debt goes hand in hand with saving, because having a lot of debt reduces your ability to save. So it's important to make a list of all your debt and figure out if you're overwhelmed by your debt payments. How many credit cards do you own? If you have more than 2 credit cards, you probably should get rid of some of them. Sorry, my dog is barking quite a bit. By asking yourself these questions and following these fundamental steps, you can be on your way to meeting your financial goals. So setting a budget is the most important part of saving, like I mentioned. So what is a budget? A budget is an estimate of income and expenditure over a set period of time. So your budget can be a monthly budget, or it could be a yearly budget. There's several different versions of budget guidelines. Some budget guidelines say you should use a 50-30-20 rule, which is 50% of your income should go towards your needs, 30% of your income should go towards your wants, and 20% should go towards your financial goals. And there's also a 70-20-10 rule, which says 70% of your income should go towards your living expenses, 20% should go towards your savings, and 10% should go towards your luxuries and wants. So this is the budget guideline that I tend to use. It says that 60% of your income should go towards your bills. So 90% of your income should not go towards your bills. It should be 60%. And your bills include your rent, your mortgage, food, school fees, car payments, clothing, insurance, etc. 5% at minimum should go towards pension and retirement savings. So pension and retirement savings is very important, and I'll go over that as well in a bit. I would say ideally aim for 10% of your income to go towards pension and retirement savings, just so that you can be really comfortable in retirement. 10% should go towards regular savings. That is your emergency fund, which is 3 to 6 months worth of living expenses and other investments. So prior to the pandemic, an emergency fund was 3 to 6 months worth of living expenses, but think about how long we have actually been in this pandemic. We've been in it for over a year. So even if you did have an emergency fund and you lost your job last year, March, your emergency fund would probably be depleted by now. But it's better to have something set aside than nothing. If you can save 1 year's worth of living expenses, hats off to you. So you'll be very, very prepared. If you can only save 1 month, at least it will be something. If you can do 3 months, it will be something. So it's good to have something tucked away in the event of an emergency. We do live in a religious country, and a lot of people tithe. So if you do tithe your 10%, you should include that in your budget. If you donate to any charities regularly, if you're in Rotary, if you donate to the AIDS Foundation, the Cancer Society, anything like that, make sure you include that in your budget. And then 15% should go towards enjoyment and luxuries. So this includes your entertainment, your travel, shopping, going out to dinner, things like that. However, you should only partake in luxuries if your bills are covered. You shouldn't be traveling or buying an expensive bag or shoes if you can't pay your rent or your mortgage and you can't pay BPL. So your luxuries are after your bills are paid and after your savings. So this is an example of a budget. You can use Excel to create your budget. You can use budgeting apps. I think Mint is a pretty good one. Or you can be old school and write on a piece of paper. The important thing is to keep track of your income and your expenses. So on the left-hand side, you have your income, your basic salary. If you're married, you would have 2 salaries there. Interest and dividend income, if you have any bonds or any stocks, you might get some income off of those. Then you have pension. So if you're retired, you might have some pension income. And then other income. So do you have a rental property? You might get some rent off of that. That could be included as other income. And then you have your expenses. And your expenses tend to be a pretty long list. So I mentioned it includes your rent, your mortgage, utilities, food, things like that. And savings is very important to include in your expenses. Once you put that as a line item, you'll force yourself to save. So make sure that you include all of your expenses. It can be pretty long, like I said, but make sure you think about everything. Go through line by line. You can look at your bank account, see what you spend on a regular month. Do you go to the barber or the hairdresser or the nail salon often? You should definitely include that if so. Do you go to the gym? Do you have a gym membership that you have to pay for every month? If so, you need to include that. Do you have any pets? What is your gas payment every month? In terms of luxuries, how much do you spend on your entertainment or dining out? Also, it's important to include your vacations in your budget, however often they might be. So if you do a quarterly vacation, obviously right now we're not able to travel that much, but when you are able to travel, you should include that in your budget. So if you go away quarterly, if you do an annual family vacation, it's important that you include that in your expenses. So your expenses should be less than your income. And your income minus your expenses would be the excess or the shortfall. It's important that you aim to have excess income because that will allow more flexibility in your budget for savings. So just a bit of budgeting tips. It's important that you update your budget on a regular basis, at least quarterly. Compare your budgeted spending to your actual spending and make adjustments as needed. Figure out if you spent more or less than you forecast. Try to minimize your non-essential spending. So do you need the highest cable package? Do you need cable at all? Do you need Starbucks every morning? Probably not. Can you do your own hair or your nails? Do you have to buy lunch every day or can you cook food? So these are some things that you can minimize to allow you to be able to save more. And I already mentioned include saving in your budget. So that includes your emergency fund, your retirement savings, or any other investments. It's important that you remain disciplined. So I mentioned that other investments are a part of savings. 10% of your budget includes other savings, and in that is other investments. One thing I want to mention is that some people were able to liquidate their investments to help them through the pandemic. So if they had government bonds or mutual funds, stocks or anything like that, they were able to liquidate those so they could get some cash to carry them through. So it is beneficial to have other investments. The next week's session is on investments, but I'll gloss over them since it is a part of saving. And so most of you are probably familiar with term deposits, savings accounts, and real estate. But due to the lower rates on deposits, typically you get less than 0.5% on a term deposit nowadays. Whereas in the past, you were able to get maybe 4 to 5%. So people are looking for other investments now so they can get a bigger return on their investment. So that includes like your stocks, your bonds, or your mutual funds. So a stock is basically just ownership in a company. We do have a local stock exchange. It's called BISR. It only has 20 listed stocks, unfortunately, but it is available to you. And then there's also preferred stocks, which operate similar to a bond. You basically lend a company money, and in return, they will pay you a dividend payment either quarterly or twice a year. And then you have bonds. So basically, a bond is lending money to the government or a company. And in return for lending them that money, they will pay you interest on it. So government bonds have become quite popular now as they've been coming out on a monthly basis. If you check the central bank's website, you can get details on that. The rates range from say 3% to around 6%, depending on the maturity of the bond. And then there's corporate bonds as well. So if you lend money to a company, it's a bit riskier than a government bond because it's more likely that a company will default on a bond than the government. So usually they pay a bit of a higher rate than a government bond. And then, like I mentioned, most people are familiar with real estate. It's a good way to have income, especially in retirement. And then there's mutual funds. And a mutual fund is basically a pooled investment, which is used to purchase securities. So it has an investment manager that will purchase securities for the fund. And in return, all of the investors in the fund get whatever interest or return on that fund. So you can reach out to the various investment houses to find out what mutual funds they offer. You can reach out to CFAL, Royal Fidelity, Leno, Colonial, and they have mutual funds that you can choose from. And then term deposits and savings accounts, like I mentioned, which you would get from the bank. Okay, so why is saving for retirement important? So retirement savings is a big aspect of saving. A lot of people don't think about saving for retirement when they think about saving, but one day we will all retire. So the retirement age, in the standard retirement age in the Bahamas is 65, and we will need funds available to cover our living expenses if we don't want to be a burden on our family members or rely on national insurance. So if you want to live comfortably and enjoy your retirement, you have to plan in advance. So do you want to travel? Do you want to have the freedom to take up any hobbies or any other entertainment? If you fail to plan, you're planning to fail. And Benjamin Franklin said this. So there is an 80% rule when it comes to saving for your retirement. And it says that you need 80% of your pre-retirement income to maintain your current lifestyle. So if you made $100,000 per year, you would need savings that could produce $80,000 per year for roughly 20 years, or 1.6 million. So that number sounds like a lot and it might scare you, but it is how much you would likely need. So it depends on what your individual lifestyle is. So not everybody would need $80,000 per year. You might be able to live off of $40,000 per year. It just depends on you. So you have to just ask yourself how much you think that you can live off of and work towards that goal. National insurance should only be considered a supplement. So a lot of people think that they can rely on national insurance when they retire. You get a pretty small payment when it comes to national insurance when you retire. And given all that is going on with unemployment benefit payments, I think it's likely that we will not be getting very high payments by the time we retire. So don't solely rely on national insurance. It's important that you have other savings. Also, people are living longer due to medical advances. So you might live to say 90 or 100, and that's 25 to 35 years in retirement. So will you outlive your assets if you live that long? The more you save, the better. And then medical expenses. That is a major reason why you have to save for your retirement. Your insurance and your doctor bills will likely be very high by the time you retire. Insurance is usually very expensive for older persons, even if you are especially if you are able to get insurance. So some people are not able to get insurance by the time they retire due to their age. So in that case, if you're not able to get insurance and you have to pay for the doctor out of pocket, it's going to be very, very expensive. So how will you cover these expenses when you retire? It's a lot to think about. Okay, so I already mentioned only 30% of companies in the Bahamas have company-sponsored pension plans. So a lot of people are not saving for retirement. Many people don't think about retirement until they hit 50 or 55, and by then you would have missed out on many years of saving. It is recommended that you begin saving 5 to 10% of your income towards retirement as soon as you receive your first paycheck, which is typically age 21. However, it is never too late. A lot of people end up working longer or relying on family members due to a failure to plan. If you know how much you want to have by the time you retire, you can use a retirement calculator to determine how much you need to save per month to meet your retirement goals. And just the same as with budgeting, it's important that you're very disciplined when it comes to your retirement savings. Make sure that you're consistent, you stick to either a dollar amount or a percentage, and it will really pay off in the end. We all hear stories about people that retire and have to go back to work because they can't afford it. Some people go back to work out of boredom, but some actually need the money to get by, and you do not want to be that person. So this slide just shows you the benefits of starting saving as early as possible. If you save as little as $100 per month, starting at age 20, at a rate of 4%, you will have $150,947 by the time you hit 65. But if you wait until 55, which would only allow you to save for 10 years, at a rate of 4%, you would have only saved $14,725. So that just shows you the benefit of starting as early as possible. And the more that you contribute, the more compound interest that you will earn. So there's several sources of income that you will have in retirement, and the more that you contribute to these before you're retired, the better off you will be. So you have a company-sponsored pension plan, an individual retirement plan, other investments, stocks, bonds, and mutual funds, real estate, other savings, and national insurance. So these will be some of your largest expenses in retirement, and you definitely have to save to cover these. You won't have an income. So how are you going to pay for your housing? How are you going to pay for your utilities? How are you going to pay for your healthcare, your travel, your food? When it comes to your housing, it's important to try to pay off your mortgage before retiring, because it's hard enough trying to pay a mortgage when you're working. And think about if you're retired, you don't have any income coming in, and you still have to cover a mortgage. So try to have your mortgage paid off before you retire, so that you only have to worry about maintenance of your home, and also downsize your home if you are able to. So a company-sponsored pension plan. A pension plan is a retirement plan that requires an employer to make contributions to a pool of funds set aside for a worker's future benefit. So some companies have allowed their employees to withdraw from their pension plans due to COVID, especially if the company closed. So while it's not ideal to withdraw from your retirement savings, I'm sure that those that lost their jobs were happy that they had some sort of savings to fall back on. So a pension plan is a good thing to have. In the event of something like a pandemic, it is something that your company may allow you to fall back on. The industry average for a company-sponsored pension plan is a 5% match. So the employer contributes to this pension plan, and the employee contributes to the pension plan. And the industry average is 5%. So they would take out 5% of your salary, and they would match that by 5%. So basically, it's like free money. You give your 5%, and the employer gets 5%. Free money. There's no reason why you shouldn't be participating in your company-sponsored pension plan. If it is optional, I recommend that you sign up. Most pension plans have a vesting schedule, which is the time before the employee is entitled to the company's contribution. So if you work at a company for a certain amount of years, you are entitled to the money that they put in on your behalf. And the industry average is 5 years. So if you work at a company for 5 years, usually if you leave that company, you are entitled to the money that they put in for you. So like I mentioned, free money, and it's a good way to save towards your retirement. Some plans allow the employee to make voluntary contributions above and beyond the 5%. I mentioned it would be good for you to do 10% because the more savings you put in, the more savings you will have when you retire. If you do not have a company-sponsored pension plan, you should consider an individual retirement account to start saving for your retirement. It's an investing tool that individuals use to earn and earmark funds towards retirement savings. This plan can be invested in stocks, bonds, and mutual funds, depending on the plan features. And a lot of the local investment houses do offer this, so shop around, figure out what they offer and what is best for you. This is popular for self-employed persons, if you're a pastor, and those without a company-sponsored pension plan. You can allocate a percentage of your salary towards the individual retirement account to be invested according to your risk tolerance, your age, and your retirement goals. So just like if you were working at a company and they take out the 5%, I would recommend you do the same thing with an individual retirement account, or you may even need to put even more because you don't have the company matching your contribution. So you may have to be a little bit more aggressive with your savings. Utilize salary deduction, automatic bank debit. So this is a good way to be disciplined because if it automatically comes off your bank account, you're not thinking about it. And you'll be surprised at how you get by without those funds. So if it's automatically coming out, you find a way to live without that money. And then you'll look at your retirement statement and be very happy at the amount that you saved in the end. Okay, so the final building block of saving, like I mentioned, is minimizing your debt. The first step to minimizing your debt is to make a list of your outstanding debt from the highest interest rate to the lowest. So your debt includes your mortgage, your consumer loans, your credit cards, your student loans. If you have any company loans at your place of employment, they should be included. Reducing your debt increases your ability to save. So if you have multiple car loans, if you have a mortgage, you've multiple credit cards, they're all maxed out, you've a student loan, you have a staff loan, it's likely that you're not able to save. So it's important that you try to reduce that so that you can save as much as possible. So make a list of everything, who the creditor is that you owe, what is the amount that you owe, what is the monthly payment, what is the rate on that loan, and what is the maturity date. Make a plan to pay off your debt, starting with the highest interest rate loans. Make extra principal payments if you can. This reduces the term of the loan and reduces the amount of interest that you pay. So if you have a mortgage, it's usually maybe 25, 30 years. You really don't want to hold that mortgage for that full 30 years because you end up spending a lot on interest and it'll just feel like forever that you're holding it. So if you make extra principal payments, you can shorten that loan and you would be able to save a lot more once that loan is paid off. So it's important to make extra principal payments if you can. You have to contact your bank to find out if there is a penalty for making extra principal payments. A lot of the banks, they typically say you can't pay off, say, more than 30% in 1 year, but you should definitely contact the bank to find out. And when you do a principal payment, you have to make sure to tell the bank that you want it to be applied to principal only and not interest. So when it comes to loans, the highest rate loans are typically your credit cards. Credit cards typically have a rate of 18 to 22%. Then you have your car and consumer loans, which have a rate of about 6 to 15%, and mortgages, which are about 4 to 7%. So the banks like to push loans and credit cards because that is how they make money. But if you want to make money for yourself, you have to resist the temptation to have a lot of debt. Bahamians are very heavily overburdened with debt, and the levels of debt are preventing people from saving towards retirement. That is why most savings accounts have less than $10,000 because a lot of people have salary deductions coming out. They have loan payments that they have to pay. And this is the culture that we need to shift away from so that we can save more. So a lot of my clients ask if it's better to invest or to reduce your debt. It's usually better to reduce your debt because the rate on your debt is usually higher than the return that you would get on any investment, especially locally where returns are usually around 4 to 6%. So if you're paying 18% on a credit card or 8% on a consumer loan, and then your investment is only making 4 or 5%, you should try to get rid of that debt first, and then you can start investing. You can also look into refinancing at a lower rate to make it more affordable and to be able to save more. At one point, a lot of the banks were trying to attract business and offering as low as 3.99% on mortgages. So some people were able to switch at that point. If the benefits outweigh the costs, go for it. But you have to consider legal fees, prepaid penalties, and things like that before you do refinance. Also aim to pay your monthly credit card bills in full. Do not make the minimum monthly payments. So every month when you get your credit card bill, it says, this is the minimum payment that you have to make, but this is your total outstanding bill. And a lot of people just pay the minimum. You shouldn't do that. You should try to pay it off so that you are not racking up a lot of interest. Credit card debt should not linger on for months. When you get the bill, it's meant to be paid. Do not use credit cards for items you cannot afford. You should be able to pay these items back within the month or at minimum 3 months. A good way to manage your credit card debt is to set a reminder every month to pay off your credit card bill. Okay, so I talked a lot in the beginning about an emergency fund, and COVID has definitely taught us the importance of an emergency fund. So why is it important to have an emergency fund? For unexpected events like a hurricane. So we get hurricanes from time to time. We're soon approaching hurricane season. Do you have an emergency fund in the event that a hurricane does come to us? An unexpected event like a global pandemic. Yes, we all thought that pandemics were very rare, but it did happen. So it's good to have a fund there just in case. An emergency fund is good for if you lose a job or if you have a medical emergency. It allows you to be able to bounce back more quickly. You will have funds set aside to pay for unexpected items. It also allows you to avoid any new debt. So if you have an emergency and you're strapped for cash, you might go and take out a loan. You don't want to have to do this. You want to have the cash available and an emergency fund just in case. It also provides you with peace of mind. Okay, so how can a pandemic affect your finances? So COVID has really affected people's income. So some people would have had their income reduced or their income would have been completely eliminated. It has affected people's ability to cover living expenses. So people have been struggling to pay for food, pay for rent, their mortgage, their school fees. It also affects people's ability to make debt obligations. So if you don't have a job, it's likely that you will not be able to make any loan payments. A lot of people have had to rely on social assistance, whether it's unemployment benefits or food assistance. Having an emergency fund can minimize the financial fallout from an unexpected event like a pandemic. So I encourage everybody, if you don't have an emergency fund, to try to start one. Even if you can only save a small amount every week, maybe $25 per week, just put it aside and you'll be surprised at how much you end up saving. It's better to have something set aside than nothing. Okay, so there's 5 lessons from the COVID-19 pandemic. I maintained my job throughout the pandemic. So you may say, who am I to give lessons on this? But through my interactions with my friends, my family, and clients, these are the biggest financial takeaways from the pandemic, and I'm sure that a lot of other people can relate. So it's very important that you save for a rainy day. Establish an emergency fund. I can't stress that enough. I'm going to repeat that over and over and over. Save for a rainy day. Have multiple sources of income. Exercise financial discipline. It's very important to estate plan. So COVID caused a lot of people to die unexpectedly. Did they have a will? Did they have life insurance? So it's very important to do some estate planning. Also, the importance of minimizing debt. So along with these lessons, I have some quotes from a few financial gurus. This one is from Dave Ramsey, where he says, money doesn't make you immune to the little speed bumps in life, but it can easily turn an emergency into an inconvenience. So that really speaks to an emergency fund. You never know. You can lose your job tomorrow, or you could have a major medical emergency, which was the case for many during the pandemic. Some people exercised all the precautions and still got COVID, and they may have experienced major medical bills because of it. So you can either have an emergency fund, you can either have an emergency and have no funds to sustain yourself, or have to dip into your savings. So yes, it would be an inconvenience to have to dip into your savings, but you will be very happy that you were prepared and much less stress. So Warren Buffett says, never depend on a single income. Make investment to create a second source. That speaks to having multiple sources of income. The average millionaire has 7 sources of income. This income can include salary, investment income. So if you have any stocks or bonds, they pay you interest and dividends. So that's a form of income. Capital gain. So if you're able to sell an investment and make money off of it, that's a form of income. If you have rental property, you can get income from that. If you have a side business, you can get profits from that. Having multiple sources of income increases your ability to save and pays off in the long run when you've retired. I am so proud of all the Bahamians that found their inner entrepreneur during the pandemic. There are so many small businesses that popped up on social media and open storefronts, and they're all thriving despite all of this. So I like to buy candles, and I've seen so many candle businesses pop up, and I've been supporting all of them throughout the pandemic. Having another business is another form of income, and if your business is successful, you can save additional money. So the third lesson is to exercise financial discipline. The COVID-19 pandemic has taught us that we have a lot of unnecessary expenses, and we spend a lot of money on luxuries like travel, dining out, shopping, and entertainment, a lot of which we can do without. Obviously, when we're able to travel again, I'm sure a lot of us will be hopping on a plane. I know I will, but we realize how much we can save by not traveling. So how many people used to go out to bars every weekend? How many people used to spend lots of money on buying clothes to go to those bars every weekend? COVID-19 has definitely provided us with a reality check and allowed us to reassess our finances. And so Warren Buffett says, someone's sitting in the shade today because someone planted a tree a long time ago. So put your money aside now. Have discipline, and you can be sitting in the shade when you retire or if another crisis occurs. Susie Orman says, stop buying things you don't need to impress people you don't even like. So COVID has taught us to think about what really matters. and prioritize our spending. Do we really need to spend money unnecessarily just to impress others? The less you spend on impressing others, the more you can put towards your emergency fund, your retirement savings, and any other investment. So the fourth lesson is the importance of estate planning. So estate planning is an important and everlasting gift you can give your family, and setting up a smooth inheritance isn't as hard as you may think. So Susie Orman said that. Unfortunately, COVID-19 took a lot of lives unexpectedly, and many people did not have wills or trusts, leaving their loved ones with the burden of dividing up their assets or insufficient assets to give them a proper burial. Estate planning can include life insurance, a will, or a trust, and it outlines your wishes should something happen to you. Most investment products, so if you have a pension plan or a life insurance or any investment product, they allow you to assign a beneficiary so that your loved ones do not have to go to court to access these assets. The assets are automatically transferred per your wishes. Keep in mind that if you leave your assets to minors, typically the financial institution will hold the assets until the child turns 18. If you have someone that you trust as a guardian, it may be a good idea to assign the guardian as the beneficiary, only if you trust them. If there's no one that you trust to give the money to your child, just assign it to the child and they'll get it when they turn 18. So the final lesson from the COVID-19 pandemic is to minimize your debt. Proverbs 22 verse 7 says, "The rich rule over the poor, and the borrower is a slave to the lender." So you don't want to be a slave to the bank. It's important that you minimize your debt. As previously discussed, the debt levels in the country are through the roof. We have no credit bureau, which regulates the amount that we borrow, but the credit bureau is coming. Our last session is on the credit bureau, which will completely change the landscape for borrowing in the country. So stay tuned for our last session. But if you entered the COVID-19 pandemic heavily indebted with multiple consumer loans, multiple credit cards, and a high mortgage payment, and you lost your job, you're likely just trying to put food on the table. So your debt payments get put on the back burner. NIB is not enough to cover a mortgage or a car payment. A lot of the banks had loan assistance programs, so that definitely helped. If you're still without a job, or if you're struggling to make any loan payments, I would encourage you to contact the bank because they are working with people in these times. We're all going through this. If you don't have a job, obviously they would prefer to help you than write off that debt. So all the banks had loan assistance programs, but eventually they will come calling for their money. But minimizing your debt minimizes your stress and minimizes the amount you owe if, God forbid, you end up losing your job. We had so much stress last year, from lockdowns to figuring out what day we're supposed to go shopping. The last thing we wanted to worry about was how to make a car payment and possibly being harassed by the bank. So if you reduce your debt, you can definitely minimize your stress and don't have to worry about, oh, I lost my job and I have all of these loan payments to think about. So it's important to minimize your debt as much as possible so that you can live comfortably.
I get that. Again.
So next steps from here, I recommend that you create a budget. So it's very important, the most important aspect of saving. Start your emergency fund. If there's anything we take from the COVID-19 pandemic, is that it's important to prepare for a rainy day. I mentioned retirement savings is a major aspect of your saving. You have to be prepared for your retirement. You have to have income for when you retire. So enroll in your company-sponsored pension plan or start an individual retirement plan. Also seek professional help if needed. So I know this was a lot to take in, a lot to think about when it comes to starting your emergency fund and saving and investing and getting a retirement plan. It is a lot to think about. It can be overwhelming. There are professionals that are out there that can help you. You should sit down with a financial planner if needed. You could visit a local investment house and get advice. There's a lot of resources out there. Make sure that those that you get advice from are qualified, however, but there's no excuse. There's a lot of financial businesses that are popping up on social media. So there's a lot of pages that I see now, and they're offering you financial advice and tips. So you basically have no excuse but to get your finances in order. So just to conclude, people mistakenly think that you have to make a lot of money to save and invest, but a little bit goes a long way. If you're saving as little as $5 a week, $25 per week, just cut out buying lunch one day. A little bit definitely does go a long way. And some of the people that seem rich are actually really broke and living beyond their means. Some of the most conservative and frugal people have the most saved up, and they will be the ones sitting in the shade later on and enjoying their retirement. So I encourage all of you to make a plan to start saving and budgeting and getting your finances in order. I want to thank you very much for joining us. And if there's any questions, I can take them now. I think they were going to take them from in the chat. You can put them in the chat if you have any questions.
Good afternoon, Tiffany. So we have one question so far. Thank you so much for your presentation. How do you promote urgency in your parents about preparing for retirement?
Yes, a lot of parents are very stubborn when it comes to saving. I think you just have to, sometimes you just have to do the research for them and then just present it to them and just say, I looked into this. I think you should start saving in this way. Depending on your parents' age, usually they should go with, say, more conservative options, because some of our parents, they're a bit risk averse and they don't want to take too much risk. So pretty safe investments are what you should probably go to them with. But if you do the research for them, or if you say, I am investing in this, or I am saving in this way, or I'm using the saving product, they'll usually listen to you.
Thank you. Next question. Can you speak to the debt snowball versus paying higher interest rates first?
Yeah, you should pay the higher interest rates first, because it's just a very high amount that you're spending. So if you have a credit card that's, say, 18%, you should definitely pay that off before the lower interest rate mortgage. So it just helps you save in the end if you start with the higher interest rate.
Okay. Another question. Are pension plans and individual retirement plans paid out the same way?
Yeah, it just depends on the rules. So you would have to look into the various types of individual retirement plans. Some of them, you're locked in until, say, retirement age, whereas some pension plans you're paid out once you leave the company. So it just depends on the company and the structure of the individual retirement plan. So some companies, they make you leave, even if you leave the company, they might make you leave that money in there until you're 65, and then you would have to go back to the company and get the money. But some companies let you take it out once you leave. So it just depends on the rules of the plan.
Okay. Next question. How do you build credit wealth with the banks if you pay off credit cards every month?
They take that into consideration. So if you're paying it off every month, they're seeing that you're disciplined with paying it off. If you do have a lot of credit cards, they tend to not like that. So you should probably minimize the amount of credit cards. But if you have a good payment history with them, it does help with your credit history.
And somebody wanted to know what's the name of the Bahamian stocks that you spoke about, and how do you go about investing in one?
So if you go to businessbahamas.com, there's 20 listed stocks there. So like your Commonwealth Bank, your Famguard, our Rockport Development, Commonwealth Brewery, J.S. Johnson. There's only 20, but they're all on that website. And basically, in order to purchase any stocks, you would have to go to one of the local broker houses. So you could buy stocks through CFAL, Royal Fidelity, Colonial, or Leno, or Benchmark as well. And basically, you would just go to them and tell them how many shares you want to purchase. You usually give them a check. You usually have to bring your identification with you, and just say how many shares you want to buy and at what price, and they would put the buy order out there. I will say that our market is not very liquid. So depending on what stock you want to buy, your buy order might sit out there for a little while. But you could just contact one of the local brokerage houses and then make the order.
I think we could take probably one or two more questions. What do you recommend as the best investment method for young people who are interested in investing? Low risk and a decent reward.
I would say starting off with a mutual fund is probably the best thing. Mutual funds are usually pretty low cost. So most of them start at around like $500 to $1,000 to start off with. If you don't have that, there's also savings plans out there which start at lower amounts. But mutual funds are a good way to get started. They have an investment manager that's choosing all of the investments for you. And then there's a variety of different strategies. They may have a conservative strategy, a conservative bond fund, a balanced fund, or some might have a really aggressive equity fund. So usually they would sit, when you go to someone that has mutual funds available, they'll usually sit with you and analyze what your risk tolerance is. But if you're a younger person, you usually can take a bit more risk. So you can buy, say, a mutual fund that has a balance of stocks and bonds. Unfortunately, in our local stock market, the stock market isn't performing that well. So sometimes you're better off going into one of the conservative mutual funds, but mutual fund is a good place to start.
Thank you. And the last question, if you have a company with no debt, do you recommend that you get a loan to develop credit with the bank?
If you have a company with no debt, unless you want to expand, then I guess you could go to the bank. But it's good to have a company with no debt. So I wouldn't encourage getting a loan just for the sake of it.
Okay. Oh, we had one other one. Which is better to start with, stocks or bonds?
I'd say a mix. I already mentioned our local stock market isn't that diverse. So I would say do a mix, definitely in our local market. If you did want to invest abroad, you could do that. Well, not at the moment, because the central bank has suspended the investment currency market program. So if you did want to buy international equities, it is an option whenever they resume that program. I would say a mix of stocks and bonds just to have a balanced portfolio. We always recommend to diversify your assets. So don't put all of your eggs in one basket. So don't put all of your money in one stock. Don't put all of your money in one bond. Just spread your money across a variety of investments, because it really minimizes the risk. So for example, if you put all of your money in, say, one stock and that company goes belly up, you basically lost all of your money. So if you put it in a variety of asset classes and companies, you'll really be better off in the end.
Okay, thank you very much. That ends our question segment. I'm going to turn it back over to Jerome to give us a vote of thanks and close us out.
Yes, thanks everybody once again for joining us here today, and special thank you to Tiffany. Excellent presentation. I see a lot of kudos in the chat. I think it was very informative and seemed like everybody enjoyed it and hopefully took something from it. I think we ended on a good note talking about investments, as that is our topic for next week, as we'll go more in depth about investments, not just the financial investments, but also investing in yourself. I think a lot of times people don't realize that that's one of the biggest investments you can make, increasing your earning potential, as well as your knowledge of other possible revenue streams like Tiffany spoke about earlier. So thank you once again, Tiffany, and thank you everybody for joining us, and we'll see you guys next week. All right, bye.
Thank you.